I want to welcome everyone to the journal entries stage 1. And on this one, we're just going to talk about journal entries and just kind of give you an idea of how to do journal entries and what the debits and credits are. This is for the source documents, the initial documents describing the transaction, because there's going to be a lot of reading of this. And then here's a group of accounts in a business is just simply called a ledger. And a ledger is just nothing more than a group of accounts. And they're labeled into three things. An asset, and we talked earlier what an asset was. Remember, basically an asset is anything that you can physically touch or have control over. And some examples of assets would be cash, accounts receivable, notes receivable, prepaid accounts such as prepaid insurance, prepaid rent, supplies, equipment accounts, building accounts, land. You could have vehicles in there, but those are all assets. You notice those are things you can physically touch or have control over. A liability is simply something you owe, and that would be like accounts payable, notes payable, unearned revenue, and then you have accrued liabilities, which are like wages payable, interest payable, taxes payable. So the key words on liabilities is the word payable behind it. And then we have equity, which is some kind of a stock. This is what's left over. This is the investment by the owners, what the owners paid into the company. They purchased stock. Dividends is a distribution to the owners. That's what you pay the owners. Revenue is inflows from the sales of goods or services. That's what the company has earned because they've sold a product or performed a service for somebody. And expenses is what it costs you to provide those services or sell those products. Okay. Then we have something real quick, is just to help. These don't have to be 100s, they could be thousands, but this is how the ledger account's organized. Assets are listed first, and they usually start with number 1. And they're listed in order how quickly they're converted into cash. That's why cash is listed first, because it's converted easily. And then 2s are liabilities, 3s are equity, 4s are revenue, 5s cost of sales, 6 is operating expenses, 7 are other revenue, which we'll get into later in later chapters, and 8s are other expenses, such as interest expense. And interest income would be a 700. Okay, now what we're looking for in journal entries, this is where we're going to spend most of our time at. Accounts are where we record transactions, and there's 3 components to every account. First is the title, which is the name of the account. Then you have space for recording the increase and decrease in the amount, and space for recording decrease. Okay. We do a T account because it looks like the letter T. And we have the definition, a debit is the left side of a T account. So anything on this side over here would be a debit, this would be a debit, and this would be a debit, and the same way here. So that's the definition of a debit. It's the left side of a T account. And the right side is a credit. Okay, now, so what we have here is what we want to type in here is we'll have a debit. We'll go to the left side. Okay, and to do that we can copy it. Oops, I didn't copy very well. There we go. And that's true down here too. It's all the way through. The debit's always the left side of a T account. And the other side is the credit. Okay? And the credit is the right side of a T account. So we'll get those filled in so you can have it. And now don't think of these as increases and decreases yet, because it depends on what kind of account it is. Okay. Now, if it's an asset account, the left-hand side increases an asset. The right-hand side, which is the credit, increases a liability, and the same thing for equity. It's the right-hand side of a T account. That's the increase. So down here in the equity accounts, this is the increase. This is broken down. Dividends increase on the debit side, because think of that as like an expense. It reduces the amount of income that you have. It reduces the amount of retained earnings specifically, but equity. Revenues increases as a credit, and expenses increases as a debit. Okay? And then the opposite is also true. When you want to reduce an asset, you credit the account, you debit a liability, and you debit the general equity account. So common stock would be a debit to decrease. Dividends, however, is a minus, so that's subtracted off. So a credit decreases a dividend, a debit decreases revenue, and a credit will decrease the expense account. Now the other line I have here is your normal balance. Normally, assets will always carry a debit balance. A liability will normally carry a credit balance. And equity will normally carry a credit balance. Okay, now and then we go down here to stock, which is a common stock. The normal for that is a credit. Dividends would be a debit. Revenue normally carries a credit balance, and expenses will normally carry a debit balance. Now, if you think about it, this kind of makes sense because this is the equity accounts. We got to think about how do we increase or decrease equity. In general, equity is a credit balance. However, there's some common stock. These are very specific parts of it. Common stock normally carries a credit. Dividends will normally carry a debit. And the reason why is those are subtracted from each other. I'll do it this way, okay? And then revenue will carry a credit balance because it normally increases the equity account, and expenses carries a debit balance because it normally decreases your equity account. Okay, so that's a brief summary of theirs. And these you really have to get to know and memorize. And when you do your journal entries, if that's the process you're going to be going through, is you're going to say, okay, what type of account does this affect? Does it affect an asset account, a liability account? Don't worry about the equity part here. Go down here. Does it affect stock, dividends, revenue, or expenses? Because these four accounts make up your equity. If it increases stock, then you want to credit the account. If it increases your dividend, you're going to increase the dividend, which would be a debit. Revenues, now revenues would be like income earned, sales, interest revenue, interest earned, something earned, that type of thing is revenue types of accounts. When you've done something and you have money coming, or you have something coming in. And then expense account, keyword there is going to be the word expense behind it. And that will be like rent expense, wages expense, prepaid insurance expense, that type of thing will be an expense account. Okay, and here's your journal entries. Debits always go first and then your credit. And these two columns have to equal each other. Okay, so if you have a 10,000 on the debit side, you have to have 10,000 on the credit side. Okay, and keep in mind, you want to make sure, how does this affect the account? Does it increase or decrease the accounts? So, and then these are the types of things, and from these we'll post them into the ledger accounts, which we'll do in the next video. And then you have, there's your headings, your date, account, that's where you put the description at, cash, accounts receivables, exactly what are you doing, and debits or credits. And then from there, the ledgers from the journal, and then we prepare a trial balance. And the trial balance is listing all the accounts to make sure that things are correct. Okay, and there's the three types of trial balances we'll get into, but we'll just do the first one this week, and the next week we'll do the other two. That is a brief summary of how to do journal entries. And the next one we're actually going to be doing some journal entries, so we'll see how that works.